Ever place a trade with perfect confidence, only to be stopped out by a single pip before the market moves 200 points in your favor? You follow the textbook retail strategy. You identify a rally-based drop supply zone and place a limit order at the consolidation. This wick captures the exact moment of failure. It triggers your stop loss, collects your liquidity, and immediately reverses without you. At this moment, the horizontal zone ceases to be a support level. It is a deliberate raid on retail stop losses. Large financial institutions operate under a constraint known as liquidity scarcity. Because their orders are so massive, they cannot buy or sell at a single price without causing significant slippage that ruins their entry. To enter a large position, institutions need an equal amount of counterparty volume. They engineer this by pushing price into obvious retail zones to trigger the stop-loss orders they need to fill their own blocks. Traditional supply and demand zones are often used as bait, engineered pools of liquidity that institutional algorithms sweep to fund their real directional moves. Smart Money Concepts, or SMC, provides the analytical framework to look past these traps and track the actual footprints of institutional execution. While retail traders rely on broad historical approximations of where the market might turn, smart money analysis maps the precise mechanical signs left by high-frequency institutional algorithms. This analysis anchors to the order block, the singular candlestick that marks a heavy injection of institutional capital. Moving from the retail where to the institutional why and when allows a trader to align with the actual delivery of price. By decoding the strict rules of an order block, you stop providing exit liquidity for the banks and start trading alongside institutional momentum. A valid order block is the final opposing candlestick right before an impulsive directional move. This origin candle functions as a rocket launch pad. Displacement is the launch sequence, an explosive price expansion, leaving the block behind with massive volume. If the price drifts away in a slow, corrective trend, there is no proof of smart money involvement. True displacement requires speed and one-sided intent. Eventually, the initial push cools, and the market retraces back toward the origin candle. This retracement is algorithmic refueling. The market returns to the launchpad to pick up remaining institutional limit orders before the next stage. The order block provides the algorithmic base where institutional volume is launched into the market. Spotting a reversal candle is only the first step. To differentiate a real block from market noise, we apply 3 mechanical filters. Rule 1. The displacement must cause a market structure shift or a break of structure. Aggressively breaking a previous structural high is the mathematical proof that the capital behind the block was large enough to shift market sentiment. Rule 2. The move must leave behind a visible fair value gap. The fair value gap is the empty void between the first and third candles. This inefficiency proves the market moved too fast to fill all orders. Because market algorithms prioritize balanced price delivery, this gap becomes a magnetic target that draws price back for a retest. Rule 3. The order block must be strictly unmitigated. Mitigation is the process of filling those pending orders. The first time price returns to the block, it fills the remaining volume and mitigates the zone. An order block acts like ammunition. Once it is touched and the orders are filled, its power is spent. Subsequent touches will likely fail. Without a structural break, a fair value gap, and an unmitigated status, a candle is just noise, not a validated institutional footprint. Identifying a valid high time frame order block is only half the battle. If you trade the 4-hour block directly, your stop loss will be too wide to achieve a high risk-to-reward ratio. We solve this by using a multi-timeframe funnel to decouple our directional bias from our entry trigger. We use the 4-hour chart as our map, identifying the broad zone where institutions have established their footprint. When price reaches that macro zone, we zoom into the 5-minute chart to find the singular, unmitigated microblock hidden within the larger structure. This surgical focus lets us set a stop loss covering only the 5-minute block, while keeping the massive profit target from our 4-hour map. Shrinking the risk profile against the macro target shifts a standard 1-3 setup into a 1-15 outcome. By combining institutional microstructure with the multi-timeframe funnel, you stop gambling on retail patterns and begin executing the mathematical edges used by smart money algorithms.